truth is that you're going to make way more money in your investments than you will in this. And that's the problem that you see out there today with most people trying to strategize this thing. But if you do it right, it can actually allow your money to pay you twice. That's the big thing, right? It's really like, that's what it allows you to do. So I just take money, put that as a down payment. That's it. I make money off of that. But instead of using my bank savings account or checking account, even for that matter, to do it, see, once I drain out my bank account, then the money's gone. It's not earning any interest, which even in a savings account at the bank, you're earning 0.nothing%. And I showed them same thing, apples to apples. It was going to save them $2.25 million over the next 25 years.
Hey everybody, Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today we have a very special guest. His name is Chris Miles. He works for Money Ripples. He is the founder and CEO. And today he is going to be explaining to us how to get your investment to pay you not once, but twice. It has to do with infinite banking. We're going to go over all topics as it relates to infinite banking, and especially as it relates to real estate investing. Welcome to the show, Chris. How are you?
Man, I am doing awesome. So glad to be here.
I love it. I'm excited about this topic because I know a little bit about it, but I think what I'm going to learn from you is excellent. And that's the one thing I love about this podcast, that I get to bring people like you on and just learn different things. So for our viewers that don't know who Chris Miles is who is Chris Miles and how did you get involved in the infinite banking world, and how did you get involved in real estate investments as well too?
Yeah, I'll tie that all in one question. So I'm more known as the anti-financial advisor, right? Why? Because pretty much financial advising in this form pretty much sucks, right? Mutual funds and the typical thing that you hear all the time about saving everything, spending nothing, saving it forever in some dumb mutual funds. Hopefully someday you'll have something. And the truth is you really don't, right? And I found that out firsthand. I mean, growing up as a kid, I wasn't raised around, financially savvy parents. I mean, my dad taught me to save a lot, but that was it. I mean, he would have been Dave Ramsey's older brother, right? He had been the guy that Dave Ramsey looked up to, said, I want to be like him when I grow up, and therefore I will be, right? And that's pretty much what we have, like my dad was that miserly saver, a good guy, taught me great values, and same with my mom as well. But definitely when it came to money, it was always scarcity. It was always like, hey, we don't have enough, right? What do you think we are? Made of money? Money doesn't grow on trees, we can't afford this. Those kind of typical scarcity things you hear about money. And so I vowed not to be like that as a kid. So as I was raised, eventually I went to college, and while in college, I thought, okay, I'm going to become a business consultant. I'm going to be more of my own entrepreneur. Well, I should have real life business experience if I'm going to be coaching other entrepreneurs about how to run their businesses. So I dropped out of college with one class to go. I thought it would just be a temporary 1-year hiatus, just take a sabbatical and then come back later to get my MBA. And then as I'm out in the real world looking for opportunities, the first one that came up was becoming a financial advisor. And I thought, well, cool. If I can learn how to run a business and I can learn about money at the same time, hey, that killed two birds with one stone, right? And maybe I might even be able to give my dad some of his life back rather than thinking he'll just work himself to death. Mm-hmm. Well, several years goes by. My dad then says, Chris, when are you going to advise me? Now you've been a financial advisor for a few years. When are you going to actually help me? And it was kind of a nerve-wracking situation because, he's always the one that taught me about money, and he changed my diapers, right? And this is the guy that's now asking me for help. So I sit down with him, and he's, and we're looking at his stuff. He says, okay, Chris, I'm 61 years old. I want to retire at some point. Y2K, year 2000 when it dipped, that was not friendly to my portfolio. I want to know what I can do right now. I want to know if I can retire. As I look at his stuff and I look at all the money he'd saved in his 401ks, he paid off his house. He was debt free, paid off his house in 18 years. He was so proud of it. And despite being debt free and everything else, I told him, Dad, here's the truth. If you want to retire today, you better hope you die in 5 years, because that's how much money you have left.
Wow.
Okay, Chris, that's not what I want to hear. So what do? I don't know, Dad. You did everything right from what we teach as financial advisors. You packed that 401k, you paid off your debt. You did everything Dave Ramsey would have told you you should be doing, right? Or whatever he taught Dave Ramsey to do, who knows? But anyways, he did all those things and it didn't work. And it bugged me. It really bugged me because pretty soon, I remember it's almost like when the student's ready, the teacher appears, right? Mm-hmm. And ironically, one of the guys I trained to be a financial advisor on my team went and quit to go do real estate investing. And I thought, yeah, good luck with that. Good luck making any money there. Well, as I call him up a few weeks later, just to see how he's doing, He's on cloud nine. He's like so freaking pumped. He's like, man, my dad and I partner on some real estate deals and we're flipping and doing this and this. And we've already doubled his income as a professor at the local university. I said, no way. That's too good to be true. There's no way that's possible in my little financial advisor brain, right?
Mm-hmm.
He said, man, it's working. And he finally challenged me. He said, Chris, how many of your clients are actually financially free where they don't worry about money? Well, if we look at the retired ones, I mean, even if they're retired, they still worry about running out of money. So I'd say none are that free. Great. Good job, Chris. Okay, how about this? How many of you guys as financial advisors are financially free off the mutual funds, not off the commissions you've been earning off these people? And as I thought about it, I said, probably none of us, because there's guys who've been working here since the late 1970s and they still can't quit. He said, there's your problem. And so it kind of led to a conversation that eventually I started to see this whole new world of alternative investments, even in the passive investing world and things like that, that I never knew existed, even as a financial advisor doing that for 4 years. It was just it was almost like this underground world, right? It's almost like popping the red pill in the Matrix and you're like waking up to the reality. And pretty soon I had to make a choice. Either I put my head down and ignore the proof that real financial advising has not ever worked and people are not retiring financially free with that advice, or do I pick the latter and keep my integrity intact and just quit? And so I quit. I quit being a financial advisor, said I'll never teach about money again. I'll just be a mortgage broker and I'll teach ballroom dancing on the side. And I did that for a while, but all in the meantime, started learning about real estate and everything else. And pretty soon, I myself was able to become financially independent in 2006, before the recession hit and everything. Mm-hmm. So I was 28 years old, financially free, and wondering what to do with my life. And naturally, I like to teach. And that's what kind of brought me out of it. And it was actually during this period of time, I learned about things like infinite banking or Be Your Own Banker, like by Nelson Nash, books like that. And, again, these real estate guys all loved it. And I was like, wait, you guys are using life insurance, whole life insurance? That thing sucks. Why would you use that? They're like, dude, you just don't get it. You don't think like it, us as investors. And anyways, it kind of got me down a rabbit hole that eventually over the years, rather than referring out to other people, we actually brought it in-house in the company that I have today, teach people how to get out of the rat race, helping them actually do what Rich Dad, Poor Dad teaches, which is how to actually, have enough passive income to quit, to be work optional, where you work because you want to, not because you have to.
I love it. Yeah. So I love the story, by the way, and I love how it transitioned now to going down the rabbit hole of infinite banking. And it's funny because over the last year, I've heard the term more and more, which even made me read a book on it. And right now we have a friend who is a tax strategist, and he's telling my friend, hey, look, if you invest X amount of dollars over the next 3 years, you can have this amount of cash flow for the rest of your life. And that kind of leads me to believe that it's something similar to what you're talking about. So for our viewers that don't know a whole lot about life insurance, don't know about the concept of infinite banking, maybe are a little bit scared, what's the easiest way to explain this concept to them?
Yeah, what it really is it's a supercharged tax-free savings account. That's what it really is. And the truth is you don't even need it to become financially free, because the truth is you'll never make enough money in it by itself to help you do that. I know there's a lot of insurance agents that are going to hate me for that, especially the guys that sell to real estate investors specifically. The truth is that you're going to make way more money in your investments than you will in this. And that's the problem that you see out there today with most people trying to strategize this thing. But if you do it right, it can actually allow your money to pay you twice. That's the big thing, right? It's really like, that's what it allows you to do. So for example, like if I go in and buy a rental property and say I just make the typical, well, not typical as much anymore. You have to be a little bit more judicious to find them. But say you get paid 1% a month on your property, right? Let's say it's a long-term rental. Now, usually if I just take money, put that as a down payment, that's it. I make money off of that. But instead of using my bank savings account or checking account, even for that matter, to do it, see, once I drain out my bank account, then the money's gone. It's not earning any interest, which even in a savings account at the bank, you're earning 0.nothing%. And then they tax you on 0.nothing%, right? Mm-hmm. But here instead, if I save that up inside my life insurance instead, right? Now I'm not talking about just buying term insurance like your normal death insurance. Like that's not what we're talking about here. Whole life insurance specifically, not indexed life like a lot of those people talk about with universal life. That doesn't work the same. But with whole life insurance, it has a death benefit, but it also has this savings account, this tax-free savings account called cash value, right? It's like the money that's actually there you can access. The problem is most insurance agents, 99+% of insurance agents, if you try to say, hey, design this for me in a way that I'll have more cash and less going to costs, they either won't do it or they don't know how to do it. Usually it's the latter. Most of them usually don't know how they can do it. I've had so many insurance agents reach out to me saying, wait, how can you actually create the numbers that you do where it has so little costs, meaning that it almost becomes, even though there are costs in those first few years, most all the cash you're putting in goes right to that cash you can then use to invest. And I was like, well, it's because I know how to do it right and you don't. It's just taken me years, literally, 15 plus years to finally find that magic formula to get the best ROI out of it and still keep it tax free.
Yeah, it's
So
funny.
anyways, so rather than, go ahead.
No, go.
I was going to say, so rather than using my bank savings account, which again pays me point nothing percent and taxes me on that point nothing percent, I use this account instead, where I'm able to, instead of just withdrawing the money, although I could do that, see, if you withdraw the money out of the account, you lose the ability to earn interest on it. Yes, you'll earn interest on the investment, but there will be no interest earned in that savings account. But if I do the same thing, I can also do with a bank, where I can actually go in, say I have a savings account with the bank, and ask them, say, look, I've got 100,000 sitting in this bank account here with your crappy savings account. Can I get a collateralized line of credit against this? And every banker will pretty much say, yeah, of course. Because what are they going to do? They're going to lock up that 100,000 and then give you a line of credit for 100,000. And so if you pull that 100,000 out, they just lock up your savings knowing that they've got collateral. And then as you pay down that line of credit with them, they free up the savings account too at the same time. Problem is they don't pay you much on it and they'll charge you more in interest. Where with the life insurance company, I can do the same thing. But the cool thing is there are no minimum monthly payments. So I get a line of credit from the insurance company while all my cash is still in there. So say I use that same $100,000, right? Instead of pulling it all the way down to almost zero, instead I have $100,000 earning tax-free compounding interest, usually earning at least 5% or so a year tax-free. And I'm also able to earn interest by putting in an investment. And even though they've charged me interest, I'm still able to net positive more on inside the account, meaning that I still earn money on my real estate project, my 12% a year or whatever, and I'm able to at least make a few extra percent a year on my life insurance net. So I actually am able to make money in two places at the same time.
Got it. So if I wanted to structure a whole life policy, I know that a lot of it has to do with the design, and this makes a lot of sense to me because of the friend that was explaining this to me at some point was saying that a lot of the times, if you structure incorrectly, most of the money that you're putting in goes into the cost for the first 3 years, and it's not really available. So I don't know if you're able to kind of share this on the show, but what is the key to structuring it correctly? Or what should we be looking out as consumers if maybe somebody is explaining this concept? What are the right ways of doing it and the wrong ways of structuring a whole life policy?
Yeah, what you want to do is you want to have more cash now and in the future when you're putting money into it, right? So really what you're doing is you're overfunding a policy. So when I design it, when our company does that, we actually try to have the minimum death benefit needed to allow X amount of dollars to go in each year. So if someone says, I want to put in, say, $25,000 a year into this thing, we'll find out what the minimum death benefit's needed to allow that much to go in as a max contribution amount while still keeping it all tax-free. Because it is like a Roth IRA, but without all the stupid limits and rules, right? Because with a Roth IRA, you got to wait till you're 59 and a half, which is not enticing for anybody under the age of 59 and a half. And I'm already, about 14 years away from hitting that age. And I think Roth IRAs suck. I don't want to use them either. That's too long in the future when I'm already financially free anyways. But, I don't have to worry about all that stuff or making too much money and all that kind of stuff that deals with Roth IRAs. In the life insurance, you put it in with after-tax dollars, it grows tax-free and comes out tax-free. And even when you die, the death benefit is also tax-free, right? So everything's pretty much tax-free with it. So I try to figure out what's the minimum death benefit needed to allow X amount of dollars to go in each year. That's the real secret. Now, there's different ways to do it because I know I see, insurance agents come out with stuff. Just recently, I had a friend who's a real estate investor. He referred his brother to a guy that's popular on YouTube. I won't mention his name because he's a cool guy. He really is. But he referred it to his company. And of course, just because you refer it to those people doesn't mean you're going to get the best deal. So this guy was pumped. He's like, man, I'm putting in 10,000 this year. He's putting in 10,000 a year, right? He's like, I'm going to have $6,000 from day one. So only 4,000 is going to cost versus a normal whole life policy. You put in 10,000, all of it goes to insurance costs. So you have zero in year one. A normal insurance policy would have zero. Second year, you would also have zero. So usually you put in that 10,000 a year for 2 years, you have zero cash in there, and voila, next thing you know, you're like, finally, I'm going to start building up some cash. Well, this guy was excited about $6,000. Well, we showed him, we said, well, that's great and all, but $6,900 to be exact is okay, but you can do better. And we showed him he could actually have $8,000 from day one. So it was like, we actually just saved you $1,100 a year on this small policy. That's not even like some other people I've had. Again, they went with Infinite Bankers, still the same old name, right? Infinite Bankers. And they were putting in about $150,000 a year between the husband and wife. And I showed them same thing, apples to apples. It was going to save them $2.25 million over the next 25 years. So the best thing you can really do is, shop around, right? If you've got insurance agents that are doing it, great. Have them show you X amount of dollars per year going in, right? Whether it's, 10,000 a year, 20,000, 50,000, 100,000, whatever you're thinking about doing, have them show it to you. And then feel free to message us at moneyripples.com and we'll look at it too. And just say, here, we can take a look. Even if you've had one from before, you could still request, if you've had it for a few years or so, you can still request from the actual insurance company what's called an in-force illustration. Mm-hmm. And if you ask them for that, they'll send you an illustration saying, here's what it will look like from here forward, assuming the current rates and all that kind of stuff. And then we can even see if it makes sense. I had somebody send it to us about a month ago. And in a few cases, usually it doesn't make sense to make any changes. It's like, you know what? You've paid your dues. You're in it. You're fine. But every once in a while, I get shocked. And, just like, another person we saw recently, was about literally like $100,000 over the next 5 years it will save by, apples to apples, putting the same money in, but just doing it better. And that's our thing. That's why we call it no BS infinite banking, because really try not to BS you around. Like, it's just give you like the best deal every time.
And let me ask you this, like in that example that you gave, what was the key difference? Like, do they just not know how to structure it? Are they making more commissions up front? Or what's the difference between the way that you set it up versus what they were receiving? Is it just that they have a provider that has higher cost? What is it?
It could be actually all the above of what you mentioned, right? I usually find it's two things, right? Either one, the insurance agent doesn't know how to design it, which is usually the case. They don't know how to get them, even with the company that they're using, or companies, if they're independent, which they should be. Even if they're independent, they don't always know how to get every dollar they can get out of it. Because I'll tell you, insurance companies just don't teach you how to do it this way, because it manipulates the system, right? Insurance company, obviously, if the insurance agent makes more money, it's because the insurance company made more money. So they love it when you do the traditional vanilla whole life, which I don't recommend typically, right? So that's one. And then even if they do know how to do it, they might make an exception. Like, just like that guy that was putting in 10,000 had 6,900. That company knows they could do better, right? They know they can, but they have this belief, like many insurance agents do, because remember, these insurance agents, that is their career. They're not investors like we are. And so they naturally will say, well, you know what? They'll still get a win. They still have a decent amount of money in there, and we still make more money too, right? And there's that belief thinking, oh, well, we got to feed our families and all that kind of stuff. And I'll tell you, that's just not true. I'm not saying that they shouldn't feed their families, right? But my experience has been, and it's been almost like been our secret, even in the insurance industry, is that we're one of the top insurance producers with a particular life insurance company, and the funny thing is that we charge the lowest fees, right? We get it designed to do that, but the reason we make more money is because if somebody knows that they're paying less in costs, they want to put more in. Give you an example. I have a friend that owns a real estate turnkey company, right? He actually just got done doing a second policy with us, but the first time he did a policy, I remember he met with an insurance agent that said, oh yeah, I do infinite banking. This is how it's done. And there's like almost no cash from day one putting that money in. So it was all going to insurance costs in the beginning. I told him, I said, listen, this guy, I know him personally. He's kind of a schmuck. You don't want to do it with him. Well, he did it anyways. And the next thing you know, 6 years later, my friend comes back to me. He says, listen, like, I put in $37,000 into this thing now, and I only have $17,000, $18,000 in here. That's not cool. And I said, no, you did it wrong. Like I told you 6 years ago. So we actually went and looked back at the numbers again of what he could be doing. And he's like, holy cow, I could put in 50,000 and you're saying I'll have $40,000 from day one in here. Yeah, only 20% comes out in cost, not 100%. He's like, that's awesome. Let's do 50,000 a year. So even though I charged, even though he did much less, like I got paid less proportionately compared to the other guy got paid almost all that cash that the guy put in the first year. I still made double the income because this guy knew he had more money. It was basically creating the win-win, creating actual value for people. Shocker, that actually works in business, right? You serve people and solve problems and you make more money. Well, that's basically what it is. You just have to have more of an abundance mindset with it. And so that's the weird thing, is that a lot of insurance agents just don't have that abundance mindset. They think that they somehow have to still, even if they could do better, they won't. And I have, again, good friends in that industry that's their personal choice. That's what they do. And I don't agree with it. I believe that people should get the best deal every single time, no matter what.
I love it. Is that a pretty good rule of thumb? About 80% should be going into the cash value versus the cost? Or because I think that if somebody thinks about it from that perspective, it actually helps them. And the way that it's been explained to me in the past, I've also seen it where it's $0 goes into the cash value for the first like 3 years. So I think it's very similar to the way that you're explaining it. So let's talk about different structures. So how long do you have to fund these life insurance policies for? Is there like a recommended time? I know that a lot of it depends on goals for the individual. Can you give us a couple of examples of maybe somebody that funded a policy for 10 years, 20 years, 3 years, and then how different people in different situations could structure different policies?
Yeah, so let me address the whole upfront thing. So understanding whole life, it's a little bit different than like just simple term, right? Because again, term is just death insurance. There's no cash in there. Whole life, the difference between this and even like universal life is that whole life is front loaded with its costs. The most expensive years are like what you mentioned, those first 2 or 3 years, right? So when we design it, we just try to make it as cheap as we can so that the first year, roughly about 20 to 25%, depending on age and health rating, will come out in that first year. Second year, it might be like 12, 13% comes out in cost. The third year, usually by the third year, it's paying for itself. So pretty much whatever you're putting in, it's growing by at least that much. And then it exponentially gets better and better. So it's really the first 2 years of the years of actual cost. Now, a normal whole life policy, it might take you for you to get finally break even. So let's just use that easy numbers, $10,000 a year, right? You're putting in $10,000 a year. Usually most companies doing a traditional whole life, you have to wait at least 15 years to break even. That means you put in 150,000, you finally got up to 150,000 of cash. With the way we do it, usually by the fifth or sixth year, but usually pretty close to the fifth year, you put in 50,000. By that point, you have about 50,000. So how many years can you do it for? As long as you want. The only thing I have people decide is, one, what do you want the max amount to be? Because you can always pay less, but you can never pay more than that max. And then two is, how long do you want that option to max fund it? And you're not committed to doing it for that long, even if you pick that way. The worst case, you just have to pay it in for 7 years and then be done. So even though it's whole life insurance, and traditionally whole life insurance, you pay it your entire whole life, right? You can do things like making a paid up policy, as they call it, where you can have it paid up in 7 years or more, depending on how you do it. So give you an example. We get two batches of clients. Usually there's two different strategies. One would be either max funding for 8 years and then minimum funding however long after that. Then another one is max funding for however long, right? Usually we stop like by your mid 60s. The one thing that I see a mistake by a lot of insurance agents is they'll run out your numbers till your age 100. Well, with a lot of companies, if you run it out that long with that kind of flexibility, they'll charge you more money. They'll have a higher death benefit so that you pass the IRS rules to do that. And again, I don't want to get too in the weeds because I don't want to get people lost here, but it just depends on what option you really want. The advantage of going 8 years is that you get the best ROI typically. And some people say, what about 7 years? I'm like, you could do 7, but we found ways to put in that 8th year for no extra charge. So you might as well just run it up to 8 years if you want, still only max fund for 7 years and then change your mind later, right? Because again, you can always pay less, but you can never pay more. That comes to another question. People will say, well, if I make that max, let's just say, 50,000 a year, what's my minimum required premium? Because that's not required. Some people think, if I put in 50,000, I've got to put in 50,000. No, you don't. depending again on age and health rating. Usually it's between like maybe $10,000 or $12,000 is the minimum for a $50,000 max. Or in other words, whatever your max is, your minimum is going to be about one quarter or one fifth of that. So if you want to put in 20,000 a year, your minimum is going to be somewhere around maybe 4 or 5,000 a year. If your minimums or maximums 10,000 a year, it might be like 2 or 3,000 a year, and so on, right? So it's always proportionate, and the only thing you have to pay is that minimum. So anything above and beyond that just adds more to your cash that you can then use to invest, and you can invest it wherever the heck you want. So unlike IRAs where you have to like self-direct and do all that kind of stuff, this is literally just like a savings account. You use the money for whatever you want to use it for. You can blow it in Vegas if you want. You can use it in your business. That's one great thing you can do there is you can actually use it in business, and you can write off the interest that you're paying to the insurance company anyways, just like you would on a credit card if you had interest charged on a credit card for business expenses. Same thing. So you can, in that case, almost triple dip when it's used for business purposes.
And I think the excellent portion about it is that if you borrow against it, the money's still working in the background, basically. So you're
Exactly.
still earning a return. So when we say how to get paid twice, that's what we mean, that you get to use the money, but it's also working in the background. Now, I know that you can do something similar with a 401k where you're borrowing a certain portion, but I know that there's a limit to how much you can borrow. Is there a limit as it relates to whole life, or can you take out the entire cash value?
Great point. Yeah, because 401ks, you can borrow either 50% or 50,000, whichever is less, right? So they won't let you go over 50,000 bucks, even if you have $1 million in the 401k. And then you have to pay back that loan with every paycheck. If you don't, you get penalized and taxed and everything else. You don't have any of those issues with the whole life. You can access up to 95% of the cash at any time. So it's really like a private line of credit that you don't have to go get bank permission for, right? Because they know it's collateralized. They know that, with whole life specifically, whole life is guaranteed to pay you at least 2, 3, 4% a year, even if they don't pay a dividend. That's their contractual guarantee. So for that reason, that's why insurance companies and even banks will be more than happy to lend on it, and sometimes not even require a monthly payment. You just pay it back however, whenever you want. The deadline for paying it back, balloon payment, if you call it that, would be at your death. And what they do is they just take it out of the death benefit and then pay your family the rest tax-free. So if you had say you borrowed over the course of your life, like $1 million from the policy, right? And you hadn't paid it back, but you have a $5 million death benefit, what would happen is they would just pay off that $1 million to the insurance company. They would take their cut back. And the other $4 million pays your family tax-free.
Yeah. I was told, and correct me if I'm wrong, somebody else said something about, I think it was the one we mentioned earlier, the UIL, or I can't think of the name.
IUL, Index
IUL.
Universal Life. Yeah.
And the way that they explained it to me, and I don't know if this was like a little bit of a sales pitch or what it was, but he said that that the downfall of the whole life is that they take away the cash, whatever you borrowed against it, they subtract it from your death benefit, and that there was a certain policy where they don't subtract that from your death benefit. Is there a certain policy where they don't, and are there any pros and cons versus structuring it this way versus the other way?
Well, no, they're kind of giving you half truths, right? I mean, so I just described how when you borrow against it, it does take for your death benefit, right? That's still true with IULs. I know because I used to sell IULs. I still can actually, technically, but I really don't anymore. I was doing that in the early 2000s to mid 2000s. And then when I started to train other insurance agents how IULs worked, because they were kind of new on the market at the time, every time they asked me a question, I'd say, oh, yeah, that's true. Oh, yeah, that's true. That could be a risk. Oh, yeah, that could be a risk too. So no, the truth is the insurance company's got to get their money back somehow, right? They're going to get it back one way or the other. So whether you borrow from it, whether you withdraw the money, you're going to have a smaller death benefit regardless. Now, if you withdraw money, you might say, well, they don't have a loan against it, but still you shrink your death benefit if you withdraw the money. So no, the death benefit doesn't do that. Now, there are some that, here's what they're really saying though. In the IULs, right, they have two types of death benefits. They have a fixed death benefit, which just stays the same your whole life. And the reason that sometimes it could be good is that as your cash value goes up, it acts as collateral for that death benefit, making the insurance cheaper. But that difference is just what they're paying on. The problem is that a lot of people don't like that because they don't like to know that, oh, I'm just self-insuring. I might as well just self-insure and not have the insurance, right? There's the increasing death benefit, which goes up as your cash value goes up, even with whole life. And this is what shocks a lot of people because I'll get haters on YouTube on my videos and stuff when they see our Money Ripples channel. They'll see some infinite banking videos that I put on, and they'll say, "Oh yeah, well you lose your death benefit with whole life." I'm like, actually, let me show you. And even after I show them, they're like, "Oh, I still don't believe you." I'm like, okay, well, call me a liar for all you want, but the proof's right there. So the cool thing with whole life is actually if you do the strategy I'm talking about doing, you actually end up having a bigger death benefit than what you paid for. So let's just say you start out with like $1 million death benefit with whatever you're putting in per year. Well, that first year, because you're max funding it, it might jump up to like 1.1 million, right? It might jump up to 1.2. You might have only put in $50,000, but that death benefit might jump up 100 or 200,000 bucks. So you actually make more in the death benefit side than what you paid into it. So again, like it's true with some policies that if you get it to where the death benefit's level, and there's even whole life that does that too, I just don't recommend those. I think they're crap. So I'd rather just, I'd rather just do it the way that they're talking about, which is you still borrow. It just does affect your death benefit. Don't believe for a second that that's the case. It's kind of like the same sales strategy that you hear some guys in the real estate space that do sell whole life and infinite banking. They'll say, oh, the best thing you can do is dump in a whole bunch of money and then pay less later on. And I had a guy actually show me that. It was a friend of mine that was in one of the real estate mastermind groups I'm a part of. He said, what do you think of this? He's like, this was sent to my friend. And I looked at it and they wanted him to dump in $750,000 year one, then down to like 450,000 year two, and then like $250,000 a year thereafter. And I told him, I said, well, you could do it this way, but the problem is that $250,000 is your minimum that you got to pay into the sucker. That's a big commitment. I said, but let me just show you apples to apples. I wouldn't recommend this strategy, but let me show you apples to apples. And still in the first year, he had over $100,000 more with my example. Then he revealed, he's like, this was actually for my benefit, not my friends. It was actually for me. I said, well, I wouldn't design it this way. And so we're actually designing it instead of him dumping in $750,000, only putting in $250,000 a year. But now he's getting like more of his cash from day one. So it's even better than the apples to apples example I showed him. And yeah, I get paid 3 times less by doing it that way, because for him to throw in $750,000, you have to have a death benefit that allows 3 times that much money to go in. So, that's why I just told him, I said, listen, this is just another ploy for this insurance agent to make more commissions. Yeah, you have cash in there, but why would you dump in the bulk of your money in the first year? That's the most expensive year. Well, the only reason is because the insurance agent wants to get paid more, because that's where he gets paid his commissions. It's from that part that comes out in that first year. So you got to be careful.
That makes a lot of sense. And then you said something about funding it for 7 years or something like that. What happens if somebody does, like, for whatever reason, they're 3 years into it, they have a car accident, they can't afford it, they get divorced, or they go through just the financial hardship? What happens if they can't afford to continue making that payment? Does that void out this type of policy, or can you put it on a pause?
It depends on how it's set up, right? If you got like the very first policy that I bought through, my former partner's partner, right? Mm-hmm. If you buy that kind of policy where everything goes to cash in those first few years, yeah, you're gonna be in trouble. That cash value is your buffer, right? It's like your emergency fund is really what it is. So don't design it the traditional way. That's what happened to me in the last recession. 2006, I bought a policy. Year 3 was 2008. I was already losing money left and right with real estate at that point. That's why I had to become financially independent twice, because I was back in the rat race after the recession. Mm-hmm. But I'll tell you, like that 2008, I'm like, I can't make this $10,000 a year payment. Or actually, it was a $12,000 a year payment. I couldn't make it. And then I said, well, can I put a pause on this? And they said, well, you have $300 of cash value in here of that savings. So the answer is no, you have to keep funding this. The difference is with our design, like I said, if I had done that same 12,000 a year. In fact, this is why I argued with that partner. I actually had a 2-hour debate with him, and he finally just told me the only reason he designed it that way is because he couldn't afford to cut his commissions, right? After I hit all of his objections.
Wow.
But the same $12,000, again, if only 80% goes into your cash, right? That means you've got roughly like $9,500 in there. Well, even in year two, let's say you put in another 12,000, instead of having zero and I have 9,500, year two, I put it in again. And let's just say year two that now I've still got about, $20,000 in there out of the 24 I've paid in. That's pretty accurate. Well, even if year three, I can't afford to pay the premium, here's the great thing is that if one, I have flexibility with the way I designed it, that at that time, the policy I designed, because it was the traditional way, the minimum and the maximum were both 12,000. I had to pay 12,000 a year. The way that we design it, usually if you're 12,000 the max, minimum is going to be like no more than about 3,000 a year. So I tell people worst case scenario is you pay at least the minimum. If you can pay the minimum, great, just do that. You can always do catch up contributions down the road. Now, what if you can't do that? What if it's worst case? Like you said, like what if it's really bad, like divorce or just crazy bills going on or something chaotic going on in your life? What if you can't pay the premium, even the $3,000? Well, if you got at least 3,000 in cash value, the policy can fund itself. So the great thing is, even from year one, I've even shown people where, year one, they max fund it and then they don't pay anything for the next 6 years and then they make it pay for itself. Still, you still have cash in there. So that's the great thing is that you can pay it 1 year and worst case, right? Just borrow from the cash to then pay the premium, which just puts the cash back in the policy again. And it can last forever, essentially. So that's the thing. It is all about that design. And that's why I designed it that way, because I wish somebody would have done that for me instead of me dropping like 25 grand into a policy that became the most expensive, crappiest term insurance ever. That would have been better.
And then where do we come up with the 7-year mark? I'm still a little bit confused on the 7-year.
Well, 7 years is just like the minimum that an insurance company requires has to be paid in. Most people, though, when you hear about it from the infinite banking standpoint, the common approach that many people will take is just say, well, max fund for 7 years and then pay the minimum thereafter, right? It's just, or just pay for 7 years and then stop completely and just let it pay for itself. Because remember, at least the way I design it, by the third year it's paying for itself. Even the traditional infinite banking designs, usually by year 4 or 5, even though it's later down the road, it still pays for itself. So you could stop paying after 7 years and it will keep paying tax-free income, dividends into that policy, whether you pay a dime into it or not. So that's why 7 years is the popular one, because the insurance company requires for whole life. Generally, they want at least 7 years of premium to be paid into it.
I love it. All right. And then how does somebody determine the minimum and the maximum? And how does that, I know that you mentioned that you guys are designing it a certain way where the minimum is not really a high number. How does somebody determine what the right minimum and right maximum is?
That's a great question. Usually this is what I recommend. Like whatever somebody's putting away into their savings or checking for investing purposes or whatever, or just savings purposes, right? Whatever they're putting into there, whatever they're maybe putting into 401ks, because most people after they hear about this are like, man, my 401k is stupid. Like this is dumb. Even with the match, it doesn't make sense. So they might stop funding their 401ks. They'll stop funding their 529 plans for their college, savings, because you can use this for college savings even if your kid doesn't go to college, or use it for whatever the heck you want, right? Or college savings plans, you have to use it for college. And only that, even if your kid wants to become an entrepreneur or they get a full ride scholarship and you're wondering what to do with all that money in a 529 plan, this way you can use it for whatever you want. So, so if you take all the savings and stuff that you could be putting away, do less than that as the max. So for example, if someone tells me, hey, Chris, I'm putting away maybe $3,000 a month into a savings account, I would say, fantastic. Don't put in $3,000 a month into this. By the way, another tip, if you pay yearly into this, just save up in your savings account monthly, but then pay it once a year, you actually save costs, insurance costs again. If you pay monthly, you pay the insurance agent more money needlessly, in my opinion. So you just do it one time. So if someone's putting away $3,000 a month or $36,000 a year, I'll tell them, do not make the max more than $25,000 or $30,000 a year. So go under that $36,000. And why would we do that? Because let's just say it's $30,000, even on the high end there. Well, $30,000, we know that's probably only going to be a minimum of about, $6,000, $7,000 or so a year. Well, if they're already putting away $3,000 a month, well, they're going to be able to pay that minimum after just 2 months of savings, right? So very flexible that way. And like I said, even if you don't pay the maximum that year, you could carry it over to next year and pay it then if you wanted to pay extra later on. So that's how you kind of determine the maximum amount. And here's another tip I'll give lately. I've been telling people to unbank themselves, kind of like has been said in the crypto space. And especially with bank failures and everything else going on, people were worried about, well, what about insurance companies? They're like banks. Are they going to fail too? And the answer is, historically speaking, no, not like banks. Banks take higher risks. They do a lot of that, arbitrage, and especially with fractional reserve banking, where they're lending out more than what they have in deposits. That's why they get into trouble. Insurance companies can't do that. They don't have that ability legally from Congress to loan out more than what they have. So they're just investing money, and they're just using the money, and they have to stay more liquid. And the cool thing is, they're even backed up by other insurance companies, by global insurance companies called reinsurance. So every insurance company has to have reinsurance on themselves, meaning that if they ever fail, they come in, the other insurance companies step in and make sure that everything's solvent. So it's better than FDIC. FDIC has like less than 2% of bank savings. Reinsurance companies have 100% of your cash as well as your death benefit protected, even if they happen to fail in that rare case.
Now, in the example of my friend, what they told him is that if he puts in for the first 3 years, I think it was like $250,000, that he would have a certain stream of income for the rest of his life. Is this the same thing as infinite banking, or is this something different? And can somebody take it from that approach? Like, meaning, like, let's say I'm planning for retirement and I want a steady stream of income for $10,000 coming in for the rest of my life. Is there a way to plan it out that way, or is that something different?
You could. It depends. You can definitely do that. I mean, it's very possible. I've shown clients, like I had one client says, I only want a max fund for 5 years and then that's it. And even though the insurance company requires 7, we just said, okay, great. Well, then we'll just take the max, even if you want to max fund it, borrow from the cash, pay it back in, right? And so he still gets in the 7 years and he still has more cash than what he paid into it, which is pretty cool. But I mean, you could do that with 3 years and just take money off of it, but it doesn't allow for a whole lot of growth. And you're not going to get paid a whole lot. Like, again, you can do it, but usually I recommend people go a little longer term than that if they want to get real tax-free income from that, because that's the cool thing. You get tax-free income from it. Nothing gets reported to the IRS. I mean, it's your money, right? And man, it's your money, protected from lawsuits of creditors. Oh, that's the other thing too. The IRS can get to anything. If they ever put a lien against you, they can get to this cash like anywhere else. Even your Cayman Islands account they can get to. I found that out from one of my clients. But the one thing that is really cool, in most states in the United States, you're 100% protected from lawsuits and creditors. So if you have a savings account and you lose in a lawsuit, they can just pull that money right out of the savings account without you blinking an eye, right? They can just take it right out and use it. They can use money from IRAs. They can use Roth IRA money. They can take all that money out, but they cannot touch the money in the life insurance because it's considered to protect your family first and foremost from a traditional perspective, right? But you could have millions of dollars in here and still they can't sue and take it out. Heck, even if you're trying to qualify your kids for financial student aid, like my case, I've got 8 kids between my wife and I and our 2 families blended together. We got a Brady bunch, and when you're filling out like the financial aid forms for college, the one asset they don't ask about is this one. So it's totally off the books when it comes to it looking like assets. But the cool thing is when I apply for a mortgage and they ask for cash reserves, like where do I have my actual cash reserves? I'll send them a statement of my life insurance and they count it. So it counts where it needs to count, but it doesn't count where you don't want it to count, if that makes sense.
I love it. Why is and I heard this somewhere else, that what happens if you overpay on the max? Can you even do that? Or is there a tax consequence if you overpay on the max? Like if for whatever reason by accident, you just happen to put in an extra $100,000 on the max.
Mm-hmm.
And can you change the max as once you have already set up the insurance policy?
Yeah. So if you do overpay, they'll send you a letter. They'll say, listen, either we send you that check back or we keep it the same, but you're basically your money's going to turn into like an IRA, right? Where it becomes taxable now. And I generally don't recommend that. They call it a MEC, or modified endowment contract. So I don't usually recommend that. The best thing to do is like what my friend did that owns a turnkey company, right? He was putting in $50,000 a year into a policy. And then we're at a real estate mastermind recently, and they're saying, where do we put our money besides the banks? Like, where do I hold it? Because I don't trust them anymore, especially like Chase banks and things like that. Well, I was like, dude, you already know. Like your money's safe in the one place that you've been saving. This is where I put all my cash reserves, other than like a little bit in the bank for that over, same day type of transactions to get the money
Mhm.
out or bill pay. I was like, I just keep it all in here. And so he set up another policy, now putting in another 100,000 a year max. So can you change the existing policy? I don't usually recommend it because you still have to qualify like you're getting a brand new policy, and it might still cause some tax issues potentially. So the best thing to do typically is usually just set up a brand new policy. One way around that is if you're ever worried that you may not be able to qualify for insurance in the future, I just tell people, well, great, we can get a whole life policy now, but then get this convertible term insurance policy. So you get this cheap term that still protects you or your business, your family, or whatever. And then down the road, if you want to, convert some or all of it to whole life without having to qualify for health again. So I've actually had somebody who got denied insurance because all within a year after she got her first whole life policy, we tried to get another one. They denied her because of some recent medical stuff that came up, but she had a term insurance policy that was at the top highest health rating. And so we said, so after we got denied on the one policy, we forgot about the term insurance. We said, oh, hey, let's just convert the term. We converted it. The insurance company said, approved, done, even after they just rejected the other one. So even though they knew that she was uninsurable at that point, they had to honor it. They had to give her the best health rating converted to a whole life. So there's things you can do, depending on the situation and what you're wanting. You can be very flexible with it, but yeah, you can get as many policies as you want, as long as you can justify the death benefit, which again, we always do such a minimal death benefit that most of the time people usually have to put away almost their entire income, which they won't allow anyways, to be able to max out on their death benefit. So there's a lot of flexibility just by doing, getting multiple policies.
And then are there restrictions on what you can invest in? Like, so for example, I know that some people have like a self-directed IRA where they can
Mhm.
obviously get access to their entire capital, but there's a lot of restrictions as to like what they can invest the money in. Can I use it as a
Right.
down payment if I'm buying a property? Can I use it to maybe lend somebody some money and earn a fixed return? Any
Mhm.
restrictions as it relates to how I use the cash value in the insurance policy?
That's the good news. There's not. So like IRA, because the problem is that when you invest, it's under that umbrella and it has
Mhm.
to be within those rules and those guidelines. And you have to worry about UBIT and all that kind of crap, right? Well, here it's just like a savings account. It's really just like a tax-free savings account using life insurance as the company is that's holding it. So you're just getting the money, the access to that money, and you use it for whatever you want. So it's not done inside the life insurance umbrella. So it's not like, for example, you want to do a lending deal where you may not get any tax benefits. If you use money from your life insurance, you're still not going to get any tax benefits, right? Like you'll have tax-free money growth inside the policy, but it's not like you're investing inside of the policy. It's outside of it. So the policy is not an investment. It's just a savings account. You're just getting that money out, whether it's withdrawing the money or getting a line of credit against it and then investing it wherever you want. And that's why I said you can blow it in Vegas if you wanted to, and they don't care. Like it's fully under your control and your power. Ways I recommend, I definitely like what you suggested, lending it out when you go, you get a contractual guarantee. Great way to make use of this infinite banking strategy. Anything that cash flows, like rentals, for example, is a great way to do it. Syndications. I had a lot of people put money into syndications and done this. Even short-term stuff. Even if you're trying to do flips, if you're trying to renovate a house and flip, it's nice to have a line of credit that they charge you daily interest, but you don't have to make monthly payments. So it's going to take you, let's say, 8 to 12 months, maybe in the long term, to try to sell that property or flip it. Well, great. Well, then they're going to charge you interest in the meantime. The interest is like, literally like 5.5 to 6%, right around
Mhm.
there. They'll charge you interest, but then you can just pay the loan back if you choose, when you finally do the sale of that property. And even if you don't, even if you choose not to, you could choose not to. For example, I had a client where she said, hey, listen, we just did 125 grand in a deal last year. We just sold the property. We made 155. So she's like, we just made 30,000 more profit. Do we pay off that life insurance loan that we just got the loan from, last year? And I said, well, do you already know where to deploy that 155? She's like, yeah, we already got the next deal lined up. I said, well, then don't pay off the loan. If you want to, just pay the $6,000 in interest or whatever you got charged, and then get the other 150,000 out there invested and do it again. Like you don't have to pay back this line of credit. It's flexible that way. It's almost like a student loan and deferral. Like they're going
Mhm.
to charge you interest, but they at least you don't have to make any monthly payments to it. And so that's the good news, is that you have a lot of flexibility there. By the way, Walt Disney, I mean, he used this as collateral to start Disney World. Like the banks would not lend him money. If you ever watch any documentary on it, you'll hear him talk about that, and that he actually used his life insurance as collateral, so the banks would step in with the rest of the money, and the rest is history, right? Pampered Chef. If your spouse or you have ever used Pampered Chef, that
Mhm.
was seed money started. Like there's so many people and companies that have been using this strategy forever. I had one client who bought an office building for his business, his practice, and then rented it out, built it out, and everything, used his money as collateral as well as the building. They gave him a 2% reduction of the best rates, commercial rates at that time. So dirt cheap interest rate. He used his money as collateral in the meantime. After the office was all built out, he went back to that same bank. It was a local bank. Went back to the same bank, said, "Hey, can I take the lien off my life insurance?" And they said, "Yeah, the value's in the building now. So yes, and we'll keep the terms the same." So he got a way cheaper rate than he ever would just doing it on his own, because he had that policy there. So there's so many different ways you can leverage it and use it. Like whether I'm using it for investing, and or for my case, I'll use it for holding my cash reserves, where I make a much better return than point nothing percent in the bank.
What I was going to ask you is, how much you earn on your money determined, and then how what the borrowing cost determined? Like, is it based on like market minus a certain amount of points? Is it based on lending in a certain amount of points? How are those two determined? Like, meaning, like, if I only earn 3%, but they're charging me 7% to borrow
Mhm.
money, how does that work out as well too?
Good question. Yeah. So the good news is dividends, as well as the loan rate, are all determined by the insurance company, and they only change it up to once per year. It's usually every calendar year they'll announce what the next year will be. So usually right around Thanksgiving time, all the insurance companies will start coming out saying, "Hey, we paid this much in dividends last year. Next year, the dividend will be this. Either it will stay the same, it will go up or go down." And then the loan rates are usually following whatever the dividends do. Dividend rates, so for insurance companies, are following interest rates in general, but it's longer term. So unlike banks, which will quickly move based on how the markets are moving, life insurance companies will move more slowly. So just starting probably about 2024, 2025, you'll see a lot more insurance companies start to raise their rates again, because the interest rates have been higher for the last year, right? So they'll eventually move. It takes a year or two for it to move, but they'll go up. So even right now, where they're paying 5.5 to 6% currently, that's based on those 2020 historic low type of interest rates. So if interest rates go up, the good news is you go up too, regardless of the stock market. That's why IULs, that's another problem. IULs are based on stock markets, even variable universal life, index universal life. They're all stock market based. These are not. They're very kind of vanilla and boring. And as I like to say with my real estate investments, boring is sexy, right? Like I like to know it's predictable. I know how to make it work. And that's true here too. Now, the loan rates are usually pretty close to whatever the dividend rate is. So if the dividend rate's 6%, the loan rate is going to be pretty darn close to 6%. Here's how you beat it, is that so remember, your money inside that account, because you're not pulling the money out, which is again always an option. But if you don't pull the money out, you just get a line of credit against it. You're earning compounding tax-free interest on that money, right? That's in the policy. When you borrow money, you're paying simple interest as long as you don't let it compound against you. So, for example, if you have, like I said, the same, let's just say that you have a property, it's $100,000 down, you put on it, it's paying you $1,000 a month. Well, if you took that 12,000 a year to pay towards that $100,000 line of credit, even if it's at say 6% or whatever, right? Well, still you'll have about $6,000 paid down that line of credit. So you'll have 94,000 the next year when you're paying that 12,000. So you're having less interest being charged. All the meanwhile, that 100,000 was in your account, just grew by say 5 or 6%. Now you're at 105, 106,000, while the balance is 94. You're earning more interest on that, compounding, while the simple interest you earn less, you pay less and less interest on the loan. So the cool thing is, as long as you earn at least half the interest rate of whatever the loan rate is, if you earn at least that much in dividends, you can win with that strategy. If you don't, if you just let it compound, where you don't pay anything towards the loan, then it's very possible that they'll just be racing each other, right? You really won't get any advantage. But the real secret to success is taking your cash flow, your returns, paying it back towards the line of credit, and then charge it back up again when you want to invest it again. So just take your cash flow that you're already put in your savings account anyways, but just put it in here instead.
Got it. Okay. And then how does this work? Like different people offer different whole life policies, I would imagine, and
Mhm.
different people have different ways of structuring the infinite banking. Um, I imagine that they all have a list of insurance providers, like different insurance providers that they go to. Who are the best insurance providers if you're going to implement this type of policy?
Yeah. So generally speaking, mutual companies are the best way to go. Mutual companies are kind of similar to credit unions. You know how like credit unions will brag that they pay back to their members while
Hmm.
banks pay their shareholders, when they pay dividends. That's why you make a little bit more at the credit union. Same thing with mutual companies. They're not owned by stock shareholders like stock companies like MetLife, for example, is a stock company. But mutual companies like Mass Mutual, Penn Mutual, even companies like Guardian, Northwestern Mutual, New York Life, those are examples of mutual companies. Those tend to be better companies to go with. But I would say my big three that I refer to that I've seen work best with the strategy I'm mentioning, definitely I mentioned Guardian is good. Mass Mutual is probably my second choice. Penn Mutual is definitely my first choice. I would say 95+% of the time we're using Penn Mutual because they allow us to be more flexible with the cost structure. Where some of the other companies, even though they might, for example, Mass Mutual pays a little bit higher dividend than even Penn Mutual does by like a 1/4%. But because Penn Mutual's costs are like easily 5% lower, well, there's no way that Mass Mutual is going to be paying like 11% a year in their dividends to try to make up for that. So that's why, like a lot of times, we have used Penn Mutual a lot of cases.
And then as a consumer, like as it relates to cost, so even like, for example, like if I'm investing in a mutual fund or in the
Mm-hmm.
stock market, or if I have a financial advisor, what I find is it's really hard to find how much people are actually making on these types of policies. Is there
Yeah,
any tips as to how to? And I'm all about people making money as well too, because
yeah.
obviously people have to make a living, people have to make commissions. But is there like uh, a way to find out how much they're making, or just for transparency purposes,
Mhm.
what's the best way as a consumer to kind of see that?
Yeah, the easiest way to know what they're making, I mean, when you can ask them, we have no problem sharing that at all because we kind of brag about how we make less, right?
Yeah.
Um, but I'll tell you, it's the easiest way to know is to figure out how much goes in the costs each year. So, like for example, if like if I do apples to apples, like if I'm doing Mass Mutual, right?
Mhm.
About 25% comes out in the first year when I use a Mass Mutual policy. Just so you know, by the way, this is a big tip for you. There are some policies out there that people talk about high early cash value, where only about 5 to 10% comes out in year one, not 20 or 25. And people just think automatically that's the best way to go, right? Well, it's a little tricky. And this kind of goes to your question too about the commissions, because all they're doing with that particular Mass Mutual product is that they're spreading out the costs longer. So instead of front loading it, they just spread it out more. So you end up, the funny thing is, Mass Mutual has another normal whole life policy that
Mhm.
after 5 or 6 years will actually beat that policy that gives you most of your cash from day one. Of course, they'll lock it up for 12 months. They don't want you to touch it and things like that. They'll put a little bit extra rules. So the best way to find out what people are making, insurance agents are making, is figure out how much is coming out of the money I put in, and they get paid a percentage of that. So if someone's putting in, like I said, 50,000 a year, 10,000, 20% goes to cost. The insurance agent is getting paid a commission, a fraction of that $10,000, right? That's how it works. If you put in $50,000 and 50,000 goes out in cost, where you have zero cash value, they just made a percentage off of $50,000 instead. So that's really the easiest way to figure it out. And most of the commissions are made in the first year. Um, After that, usually it's very little commissions after the first year. That's why, again, many people say, well, dump money in the first year because that's where they make the biggest commission, right?
Yeah. It's funny because I have a 401k that I've been funding for since I got started in real estate and I started the S corporation. Um, do you ever recommend that you stop funding that and do the infinite banking strategy instead? And the reason is that a lot of times with the 401k, like your money's trapped till you're like 60 years old.
Mhm.
Yes, I think you receive a 20. I think whatever you put into it, there's like a certain amount that you can write off that year. But if you put it in a whole life policy, maybe you can invest that money into a piece of property where you get 20,000 in depreciation anyways, and you have the
Yeah,
money available to you so that you can be working the money. Do you ever get people stop funding their 401k and do the infinite banking strategy? And what are
all
the
the time.
pros and cons of doing it?
Yeah, all the time. I mean, you really just want to make sure you have the right vehicle to get you where you want to go, right? Like if I'm going to go to Paris, I'm definitely not taking a car because, if you're not sure, I live in the United States, just so you know, the car can only skip so far before it drowns, right?
Right.
You need an airplane, you need a boat, you need the right vehicle to get you there. So I'm not saying that 401k is always bad, right? I'm never going to blanket statement like that. And you're right. If you have goals where you don't care about accessing money till you're at least 60 years old or whatever age that the government determines at that time. So if you trust the government and you trust them with your life and you think putting the money in 401k to not get, you get a temporary tax deduction, only pay taxes later. So you really don't get any tax benefit from 401k either if you put it in that light. So if you're okay with that, fine. That's a great place and it could work. I mean, self-directed 401ks, Roth 401ks and stuff. Like if you're putting money in places where you wouldn't get any tax advantages, like lending in many cases, right? It could be a great way to go. I would rather do the Roth 401k if I'm going to do that versus a traditional 401k. But if you have goals to, have access to money or enjoy your money before you're the age of 60, and you don't have to get a 10% penalty and taxes on it like you would with a 401k or an IRA. If you're wanting to do like what you said, invest it and not lose any of the tax advantages, like in real estate, which is a great example, this is exactly it. Because whatever tax rules apply, if you were just to use your savings account to go invest somewhere, that also applies to you as well. So if you're a real estate professional, you eat this up all day long. You want this because you don't want to put your money in a 401k, which really gives you no benefit anyways, right? It just delays your tax to a later date. And I'm a pessimist. I just don't trust the government's going to have lower tax rates for me in the future. I mean, heck,
Yeah.
inflation alone, even if they kept tax rate the same, inflation alone requires me to pull out more money, which puts me in a higher tax bracket regardless. So, I mean, again, like there could be a reason for a 401k on a rare case, but for the most part, a lot of people, when they finally get this, and they, especially when they're like you, or you're like, well, I'm going to use this to invest. They're like, why would I use this dumb 401k unless I'm doing notes and I'm okay delaying that access that money until I'm old, right? How about I just use it now? What if I can get benefits at the speed of my money today? That's what you use the whole life for.
Not only that, but as a real estate investor, I mean, you can buy a property below market value, have
Yeah.
300,000 in instant equity, which in a 401k that may take you 20, 30 years to do so. So if you know how to invest,
Hmm.
you can actually grow that money. I have enjoyed this tremendously. I think that you're a very honest, transparent individual, and I love the level of transparency. Um, is there any other final thoughts, Chris, that you think would be helpful? Any final tips to people? And then, how can people get a hold of you if they've enjoyed this interview as much as I have?
Yeah, I would say final tips is, who is this not for, right? Because I don't want people to think this is too good to be true. Because, like you said, I have to be honest and transparent. It's not for somebody who's probably over the age of 70. you know, it's also not for somebody who's paycheck to paycheck. I kind of mentioned that. You have to. I would think if you're going to use this strategy, you want to save at least 5,000 to 10,000 a year as a max amount contribution. Depending on your age and whatnot. And then also too, like if you're in bad health or you're a smoker, things like that, it's going to be expensive. Like the insurance costs are going to be more. The good news is there is a way around it. I did have one client where he was like 400 pounds and he's like, I'm in my mid 50s, 400 pounds. Even if I get qualified for this, it's not going to look pretty. He's like, can I put this on my wife instead? I said, well, of course you can put it on your wife, your kids, business partners, anybody who have a financial interest in, you could put it on them. And so we ended up putting it on his wife. We're putting 110,000 a year into his wife's policy, who's younger, healthier. And by the way, women just naturally, because they live longer, have lower costs than men, even though they're the same age and the same health rating. So we just leverage that benefit. And then, like I said, we get policies on kids all the time where dads or moms will say, hey, why don't we pool their money together, go and invest it? Or if we're paying our kids $12,000 a year or almost 13,000 a year, tax-free money from our businesses, Why don't we just use that to fund the policies? So now we're growing the money tax free after we just got the tax deduction from our businesses. And then we grow it tax free and it can come out tax free and still invest in real estate, which then has tax advantages. And, we just keep, growing it. So again, it's case by case. And so you want to make sure it's the right fit. A best way to know though, of course, your last question is, how do you contact us? Moneyripples.com. There's a contact us page right there you can check out. You also have a YouTube channel called Money Ripples. I know it's really original. The Money Ripples channel, where we even have an infinite banking playlist. So if you ever want to go down that rabbit hole a little bit, there's a lot of videos on that too.
Got it. Last question. How do we come up with the name Money Ripples? What does that mean to you guys?
Yeah, so it was actually I've had this company now for about 11 years, and I was working with a guy named Garrett Gunderson. You might have heard of him because you read his book about some of the legacy stuff, right? So him and I had created a business together. I helped him create the whole cash flow process he mentions in that Rockefeller book, as well as the cash flow banking. And but it was getting to the point where I felt like it was time to leave. And granted, we blessed a lot of lives. Like that cash flow process I created. I mean, we literally saved people millions upon millions of dollars. And I was trying to come up with some cool name, and I couldn't find it. And finally, I was out for a run. Like most of my ideas happen is usually when I'm running. And out for a run, I was starting to think about the vision of my company and what we're really to do. And I thought about a lot of the hundreds of lives I've already been able to be lucky enough to bless, especially with the average people finding 34,000 a year of cash flow to free up without even passive income, just freeing up cash flow. And I thought about one family in particular where I remember the husband and wife. The husband's working 6 days a week. They're slaving away, didn't have time or energy for his family on the weekends. We freed up $6,000 a month for him. And that allowed him to stop working weekends. He bought a $6,000, four-wheeler that first month, right? So he took the $6,000 he saved, bought a four-wheeler. But his wife said, yeah, but Chris, you got to understand, that was the best investment we could have made because now he stopped working on the weekends. We take that four-wheeler out every weekend. My kids have their father back and I have my husband back. And I thought about how that didn't just bless their life as a couple, it blessed his kids' lives and gave them a new legacy. And what kind of ripple effect it creates through the generations beyond them, not to mention his community, state, and even across the world. And that's when all of a sudden it hit me, Money Ripples. And that's what we're really here to do, is that it's not just about being blessed financially. I mean, it's great to be blessed financially personally, but it's the same reason why I'm not retired, quote unquote, right? Is that I still feel like I have a lot to give. I have a lot of gifts that I've been blessed with and that I have a lot to share that's been given to me by God. And same thing, I believe that from everybody on this planet, is that we're here to leave the planet a better place than what we came to. And so that's kind of where the whole Money Ripples concept came from, is that ripple effect we can create as we are blessed financially to help bless others' lives.
I love it. Great. Well, Chris, I've enjoyed our interview a lot. Thank you so much for taking the time to be on the show. For our viewers out there, if you've enjoyed this interview, make sure to hit that subscribe button. If you feel that this interview would be helpful to any friends, family, or neighbors, make sure to hit that share button and send it to them. And if you find value in this interview, make sure to reach out to Chris. Chris, thank you again. Our viewers, thank you again. And until next time.